Hey everyone, when you think about investing, the S&P 500 probably comes to mind, right? It's the gold standard, a simple, diversified bet on the 500 biggest companies in America. But what if I told you that under the hood, that idea of diversification is hiding a massive risk? Let's take a closer look.
So that leads us to the big question for this whole explainer. We're all told to buy an S&P 500 index fund to get broad exposure to the American economy. But are you truly getting that? Or are you actually buying something completely different? The answer? Well, it just might surprise you. And boom, here's the answer. This chart tells the whole story. A tiny handful of tech giants, the so-called Magnificent Seven, now make up nearly a third of the entire index's value. Just let that sink in for a second. The performance of just 7 companies can basically steer the entire market, while the other 493 are just, well, they're along for the ride. The whole point of diversification gets a little shaky when an index is this top-heavy.
Okay, so how did we get here? How does an index with 500 companies in it end up becoming a concentrated bet on just a few of them? The answer is actually baked right into how the index is built. It's a system that, it turns out, has a pretty big problem with winners.
So most S&P 500 funds, the big ones like SPY or VOO, they use what's called market cap weighting. And it's a really simple idea. A company's influence is based on its total market value. The bigger the company, the bigger its slice of the pie. Simple enough, right? But this simple rule, it creates a really powerful feedback loop.
Let's walk through this loop together. Okay, so a stock's price goes up. That means its market cap gets bigger. Because its market cap is bigger, its weight in the S&P 500 also gets bigger. Now here's the crucial part. All those trillions of dollars in passive index funds are now forced to buy more of that stock to keep up with the new weighting. And all that buying pressure, it can push the price even higher. It's this self-reinforcing cycle that just lets the winners keep on winning.
And this right here, this quote gets to the heart of what our source material calls success bias. It's the fatal flaw in the system. By its very design, market cap weighting guarantees that you are always most heavily invested in the companies that have already had a massive run-up. You're buying yesterday's winners, which can be a pretty dangerous place to be when that momentum finally shifts.
And you know what? This isn't a new problem at all. As this timeline shows, we've seen this movie before. Back in the 70s, it was the Nifty 50. These blue chip stocks everyone thought were a sure thing. Then in 2000, it was the dot-com darlings. In both of those cases, extreme concentration led to a really painful correction and what many now call a lost decade for S&P 500 investors. History doesn't repeat, but it sure does rhyme.
So, if the standard index is basically a momentum fund in disguise, is there a better way to do this? Well, that brings us to a really simple but powerful alternative, the equal weight fix.
The concept is incredibly simple. In an equal weight index, every single company gets the exact same slice of the pie. For the S&P 500, that means all 500 companies each get a 0.2% share. A tech giant like NVIDIA has the exact same influence as a regional bank or a retail store. It's a true investment in the average, large American company, not just the biggest ones.
So you can see here, we're really talking about two totally different philosophies. On one side, you have market cap weighting, which just lets its winners run. It follows the crowd, it doubles down on whatever's popular. Then on the other side, you have equal weighting, which is pretty much the opposite. It takes a disciplined, almost contrarian approach. It systematically trims its winners and uses that money to reinvest in the companies that have fallen behind. And this automatic discipline is really the most powerful part of the whole equal weight strategy. It has this built-in mechanism that forces it to behave rationally. Let's call it the rebalancing engine. The beauty of this engine is that it forces you to follow the oldest rule in investing: buy low and sell high. And it does it automatically, without any emotion or guesswork involved. It's not a prediction, it's just a simple mathematical requirement of how the system is set up. Let me show you exactly what I mean. Okay, so imagine it's the end of a quarter, and your portfolio looks kind of like this. Some stocks did great, and now they're way bigger than their 0.2% target. Other stocks have struggled a bit, and now they're smaller. The whole portfolio is it's out of balance. So, the fund rebalances. It automatically sells a small slice of those overperformers, it's taking profits, and it uses that cash to buy more of the underperformers, bringing them right back up to their target weight. And just like that, every single bar is reset to 0.2%. This process forces the fund to sell high and buy low quarter after quarter, like clockwork. Now, this isn't just a neat trick. It's actually backed by some well-known ideas in finance. First, by giving more weight to the smaller companies in the index, it helps capture the size premium. That's the historical tendency for smaller companies to outperform larger ones over time. Second, it's a pure bet on mean reversion, the idea that what goes way up or way down eventually comes back to the average. And, maybe most importantly, it helps reduce your risk if one specific sector, like tech today, gets a little too overheated.
All right, so we've covered all the theory, but what are the real-world trade-offs for an investor? Let's break down what this actually means for you and your money.
So there's no free lunch here. Because the equal weight strategy has to do all that rebalancing, it has a slightly higher expense ratio. We're talking about 0.20%, compared to a rock-bottom 0.03% for a standard fund. And all that buying and selling can also generate capital gains, which means it might be a little less tax efficient if you hold it in a regular taxable account.
But hey, it doesn't have to be an all-or-nothing choice. A really popular way to approach this is something called the core satellite strategy. The idea is simple. You use a super low-cost market cap fund as the main core of your portfolio. Then, you add a smaller satellite position in an equal weight fund. This way, you get to de-risk from all that concentration and improve your diversification, but without completely ditching the standard index. It's kind of the best of both worlds.
And all this brings us to our final thought. The standard S&P 500 has really become a momentum fund in disguise, making this huge bet on a few giants. The equal weight approach, on the other hand, brings everything back to the law of averages. So the question you have to ask yourself is this: are you really investing in the broad American economy? Or are you just making a concentrated bet on yesterday's biggest winners? The answer to that could change how you build your portfolio for the future.